podcast where we put you on the map. This is Ron Costa broadcasting live in the Mappable USA studios in Las Vegas. And folks, one of our last podcasts, we looked about coronavirus and opportunity zones from an accounting perspective. Today, we're going to take it more towards a legal end. And in order to do that, let's bring in Vicki Hutchmala from the QOZ Marketplace and the Opportunity Zones Authority. Vicki, how are you today?
I'm outstanding today, Ron. We've got an excellent guest. We're going to talk about opportunity zones from a legal aspect, as well as the impact they're having and perhaps the future of the program. So let's get started.
Yeah, let's bring them on then. So, folks, meet Brad Molotsky. Brad is a partner in the law firm of Duane Morris. And, Brad, how are you doing today?
I'm doing great. It's rare that I get on a call and somebody is so excited to have me on the call. Wow. So
hey, listen,
I'm doing great. Thanks for having me.
I got to tell you, you're not the only one who had a coffee before this podcast. I did it too.
100%.
Yeah. So I understand that you are the co-head of your firm's Opportunity Zone practice. Is that right?
Yes, that's exactly right. We've got about, depending on what day it is and depending on what deal we're talking about 20 or so folks in different disciplines that pay attention to and work on different aspects of transactions generically, but in particular in the opportunity zone world. So we've got real estate practitioners like me. We've got tax practitioners. We've got fund people. They're fund, F-U-N, but they're also F-U-N-D people. And so we've got kind of bases covered on a variety of pieces of the transaction. So whether you're a owner, operator, sponsor, or whether you're a builder, or whether you're an investor, we can be helpful, hopefully.
Okay, that's great.
Opportunity zones and the funds that invest in them are a lot more complicated than people realize, and they need to have legal representation and financial planning representation to be able to do it right, set it up right, so that down the road it doesn't fall apart on you. It's very important.
I think Vicki, I agree with you. It's always a good idea to have good counselors. We're not the only people out there. There's plenty of other very good, seasoned practitioners that can be helpful. But I think your point's right, meaning you want to make sure that as an investor that you've got the right gains to put into the program so that it works, and you want to make sure that your bases are covered. So whether it's a financial person, whether it's an accounting person, whether it's a legal person, they're all relevant in the equation. I tend to disagree a little bit with some of the folks in the arena in the sense that I don't think the program's all that hard. People make it sound more complicated than it is. There's a couple of rules. There's a couple of benefits. If you understand the contours of that, yes, there's a lot of nuance at the edges as to where you can sort of push dollars and transactions. But the four corners of the program are pretty easy to understand. And so I think that it's not as complicated as people make it out to be. I do agree with you, though, that having the right counselors to help you along the way is important.
And it's even important once you get it all set up and once you're ready to go, you also have to take it a little bit further, and you have to make sure that you have the right developers, the right project managers, the right people at that point, so that the project that you've invested into in whatever opportunity zone that is, that they have a success rate and they have a little bit of history to make sure the project becomes successful today, 6 months from now, and 5 years from now.
Yeah, and that's totally true and totally accurate in the sense that the Opportunity Zone program is really no different than any traditional real estate deal, although there's a bunch of better features, what I'd say. Meaning, the deal needs to pencil, and it needs to hunt, and you need to get an appropriate return, and you need to allocate risk appropriately given the transaction. And so that doesn't change in an OZ deal merely because it has the words Opportunity Zone involved with it. You still need a good deal. You still need a good sponsor. You still need to make sure that your contracts say what they are intended to say. You still need to make sure that you're building at the right place because, if it was easy, everybody would do it. And so the deal still needs to make sense. And as we're wont to say, I won't be the first one or the last one to ever say this, but the Opportunity Zone program doesn't make a bad deal good. It makes a good deal very good. And so, again, it's not the magic panacea for everything, but for a variety of transactions, it's a very good deployment of capital and results in certain things that you can't get in other deals elsewhere, in particular the returns.
And all opportunity zones, basically all 8,700 of them, they're all competing with each other for people's money. They're not created equal, and you have to, again, do due diligence to pick the right location for what you're doing based on analytical and demographic information. Just because you live in Vegas doesn't mean you should invest in an opportunity zone here.
Correct. Let me rephrase what you just said, though. So I agree with what you said. So the fact that you're in a zone doesn't mean you should invest. The fact that you're outside a zone doesn't mean you should invest. And not all zones are created equal. I mean, they were all created under the same rubric. But there are certain areas that are, again, depending on who you talk to, better, more in the path of development, and so more likely to be successful than other areas. And so some state governments took the position, well, we want to put these in our toughest neighborhoods. Others took the position, well, let's kind of almost like Hansel and Gretel, let's put some breadcrumbs down to lead people to our toughest neighborhoods, and so let's put it in the path of development. Neither is wrong. It's just a different way of achieving economic development and a different way of incenting development in a particular area. All of the areas, whether they were urban or rural, suburban or city, all had to fit into the federal government's sort of four corners of meeting HUD census data for low, moderate income areas. And so the federal government, doesn't do too many things great. But in this instance, they said, look, we're going to put the criteria out there. The states are going to be the ones to choose this. So we're going to give you a map. It's going to show you HUD census data that's eligible. You, state government, governors of all 50 states, and U.S. Virgin Islands and Guam and Puerto Rico, you guys and gals are going to be the ones to make the decision. So take the map and figure out kind of what zones work for you. Pick 25% of them, and those are the zones. We're not going to debate whether it's good or bad. That's up to you to decide for you locally, regionally, what makes sense. And so they stayed out of it, which was, positive, I think.
Right, and I think it's also you need to have local government entities and agencies need to partner with the opportunity zone investors for projects to make sure that there's somewhat of a symbiotic relationship so that the local government is helping to kind of cause you to come and invest in their location. If you don't have the local people helping you with streamlining the process as far as the project goes, then it just makes it more difficult and you're going to go somewhere else.
I think that's right. I think it's happening less than you'd think, though, meaning I think there are places like Erie, Pennsylvania that's done an extraordinary job, other places like Phoenix. There's certain cities that have really embraced the program.
And Vegas is one of them.
Vegas is one of them for sure, cobbled together a nice plan so that developers that come in can go to one place, look at where are the zones, where are the schools, where's the power lines, where are the roads, and quickly get to a place where, okay, that makes sense to me or it doesn't. Which is great. We've consulted with a variety of municipalities, counties, cities over the last 2 years, and they come at it with the desire to be helpful, but the advice tends to be, look, you got to take your zoning map. You don't have to, but the suggestion is take your zoning map, what's permitted, have a conversation with the powers that be, whether that's the mayor or city council, whatever it is. Decide what it is within those areas that you think makes sense, but don't just do it in a corner. Talk to the people that are going to be affected, the people that live in that neighborhood. Have a conversation about it, convene people, and then overlay on the opportunity zone what the zoning permits and what you're interested in seeing, and do an RFP so that developers don't have to waste their time trying to figure out what's good, what's not good, what the government wants, what it doesn't want, what the neighbors want. Do that convening. That's what you can do well at the local level. and the developers will then opt in, opt out based on what it is that you're asking for. That's a much better use of their time and energy than working for a year on something and then having the government say, well, no, we're not really interested in a hotel, or we're not really interested in multifamily, or we don't like student housing there. That's just a colossal waste of time. And so I think that, to your point, convening those local resources to assist the developer and put them all in a place so that they don't have to go hunt and peck online or in person makes a hell of a lot of sense.
Well, and participation of everybody makes things work easier.
Absolutely.
You're right, Brad. That sounds pretty easy.
It sounds easy. It's harder than I make it sound, but all that takes is fortitude. And so it's not, the developer is not going to be the one to convene a group of neighborhoods. That's really local government, talking about what are your values? What do you want to see here? Do you want a gym, or do you want residential? Do you want 2-story, 5-story? It may not be deliverable, but until you ask the constituent people that live there, then you're just kind of making it up. And so the last thing the developers want is to fight City Hall and fight the neighbors. They want to do a project, make some money, and do hopefully what's good for the neighborhood. And so if the government can take that role of convening, which they should be good at, and provide that information to people to make informed decisions, that to me is a much better deployment than a developer coming in, looking at, well, what's by right? I can build a 5-story tower here. Let's go do that. I don't have to go through an entitlement process. I know that the zoning permits this, and so I'm going to go do that. Again, that's not wrong on behalf of the developer, but that may not be what the town or the citizenry want. And so getting that input is, important.
Right.
In my view.
Yeah, I agree with you. I think that's absolutely right. Listen, I had a couple of questions I wanted to ask you about this whole coronavirus and its impact on opportunity zones. But before we do that, let's get back to Duane Morris a little bit, the company. How did you guys set up your own little area there, just dealing with opportunity zones? Is that something that you guys saw this need and decided to go forward with, or how did you personally get involved in this as a perspective on the legal industry, really?
I'm not sure the time allows for that, but suffice it to say, the things that interest me personally and professionally include kind of the following. I have worked as a general counsel at a public company, Brandywine Realty Trust, great company, doing great things, and I was there for about 18 years. Really super company. They bought land, they built buildings, they bought companies, they sold buildings, they leased them, they managed them, they financed them, and they were public companies. So we raised public equity and public debt. So got to see, a lot of really interesting transactions. Not all times were honky-dory. So we went through like 2 sort of different bubbles during our time there. And the company was doing exactly what it should have been doing, leasing space. The tenant base was great. But the stock market just, didn't reward because in 2009, like all hell broke loose. And so, I got to see a bunch of really interesting things during my tenure there. And so what interests me is development. It tends to be complicated, but it doesn't have to be. So building buildings, doing development, and kind of threading interesting needles on incentives and finance are very interesting to me. I also am interested in sustainability and was lucky enough, the CEO had given me kind of the responsibility to help the company create a sustainability program. And through that, got a bunch of people involved, met a bunch of really interesting local, regional, national people. And so sustainability, energy efficiency, how a building operates and what it can do, and how that impacts people's health on the customers that are the tenants and the employees that are in there and the vendors. That's interesting to me, whether it's the building itself or whether it's social justice on the environment within which it operates. That's curious and interesting to me. How can we make that work? Affordable housing for special needs adults is a personal thing. My older guy's a special needs guy, and so started to pay attention to that issue and how do we buy land, get approvals, build buildings, and intersect services. So all of that, we'll call it in the last piece, I guess, is on leasing. We did a lot of leasing at Brandywine, so I like leasing. I teach it. I enjoy doing it. And the firm, Duane Morris, has an active cannabis practice. So we're one of the few big firms that got into cannabis early. Now there's a bunch of others, which is fine. But I do a bunch of cannabis leasing. So those four things, development and public-private partnerships, cannabis leasing, social investment, and sustainability, all of it are interesting to me. And so my deals tend to be in one of those four buckets or two of the four at a time. The opportunity zone, when it came into existence, a friend, colleague from 35 years ago started talking to me about it, and I was like, that can't be right. It just doesn't sound right. This was before the Tax Act was passed. He's going on and on about it. I said, yeah, whatever. That sounds great, but that's not, of interest to me. Christmas happens, Tax Act gets passed, 2,975 pages of a Tax Act, 6 pages kind of tucked into the middle of it are the opportunity zones. And, January, the first week goes by, second week, third week goes by, and something comes across my desk where it starts talking about deferral, reduction, elimination after 10 years. And something like dawns on me that I've seen this before. It's tax-centric. That typically doesn't overly interest me. But I've heard this before. So I call the guy up, and I say, Harold, is this what you were talking about? And he says, yes, it is. And I said, okay, I'm now paying attention. Talk to me about this thing that's the opportunity zones, and what is it? So it's deferral, until 2026, and it's reduction, 15% last year and the year before, 10% 2020, 2021, off of the capital gain that you would otherwise have to pay on. And if you stay in the zone for 10 years, then you sell either a business, so it's not just real estate, a business or real estate after 10 years, but before the end of 2047, 100% of the sales proceeds is capital gains tax-free. And now like 39 states, also are capital gains tax-free. So he says this, and I'm like, okay, I think I now understand what you were talking about. Let's talk about why you think it's going to be a big thing. So we started having that conversation. I hang up the phone. I'm like looking at the phone, like one of those aha moments. This is like the third week of January of 2018. I'm like, oh my God, I think this is going to be like sliced bread, Starbucks coffee. Oh my God, this is it. And so I started running around and talking to anybody with a heartbeat, guy on the street, gal in the store, it doesn't matter. And, have you heard about these opportunity zones? We've got this great thing, deferral, reduction, freedom, and everyone's like looking at you like, what are you talking about? And I have like a big Rolodex like you guys do. And so I'm talking to all these real estate people because of all the folks I've met along the way. And they're all looking at me like I have 3 heads, which that's not rare. But the fact that, they hadn't heard of this thing was kind of surprising to me. And so happened to come across one of my friends who had helped us at Brandywine structure our tax stuff for 20, 30 years and asked the same question. Hey, Joe, are you aware of this opportunity zone stuff? Yes. What do you think about it? He says, I think it's going to be huge. And I got asked, he says, I got asked to kind of co-head our KPMG practice in this area, so I'm going to be paying attention. And so for the first couple of months of January, we were listening in on a bunch of calls. We were talking to trade associations like Real Estate Roundtable and NAREIT and ICSC. What were they thinking as they started to coalesce groups around the issues that were involved in the opportunity zone drafting, because there was no regs and like it was kind of cobbled together at the last minute. Yeah. And so that became kind of the quixotic journey to, we started to have, in this probably March, we started to have monthly launches every couple of weeks. And at this point, nobody's talking about it. So April comes, May, there's like an article out. Then June, there's 2 articles out. Then July, there's an article a week. And then now you get to kind of there's an article every day on opportunity zones. So until the regs really came out in October of 18, everyone was kind of like, I think this is like a tax thing. It's not real. The regs come out. It's real estate centric. People start to focus. We closed the deal at the end of November of 18, and then we closed the second part of it in January of 19. And then as more guidance came out in April of 19, more and more people started to get on the bandwagon. And now you can't open a trade rag without seeing some story about opportunity zones. And so we've gotten lucky, I guess, and been in the right place. And I speak a bunch and talk a bunch and write a bunch. So, we've closed about 46 opportunity zone deals since the end of 19, and I'm working on another 34 of them right now. Wow. They're all different kinds of transactions, and the team helps, and the more people we meet, the more we're getting more than our fair share, I guess, of transactions. The room tends to be dominated by tax people, which is there's nothing wrong with that. They just tend to speak a little bit differently than I do, and I tend to like you guys, I have a little bit of colorful language, and I've done deals. And so if you can speak in deal parlance instead of code parlance, we've been relatively successful there. So really enjoy it.
It leads perfectly into my next question for you then.
Yeah.
So we're talking about coronavirus all the time. How has that affected the deal flow? What are you seeing right now?
Yeah, so I think that, it's the reality that we're in. And so there's no getting around it. It's just a question of what's the effect, as you ask. And I think that, for a couple of weeks, people paused, for sure. They were concerned about their personal situation, their kids, their parents, their spouses, loved ones, and still are and should be. But, so there was a pause in the marketplace. A bunch of deals that we had cooking paused. None of them, knock wood, none of them fell out of bed. Nobody terminated any of the deals we've been working on, which is, again, I'm just one guy. There's plenty of people that do this work, but it's anecdotal. And so of the 35 deals we're working on now, none of them stopped. It took about 3-4 weeks, and a couple of them asked for extensions. A couple kind of wanted debt financing to be extended because it was going to expire. And they got that because everyone was kind of looking at each other, and we got extensions on closings and we got extensions on financing. And then an interesting thing happened. Like in the last 3 weeks, I've landed like 6 new transactions. We'll see if they all kind of make it to the goal line. But these transactions are solid, good deals in the, call it, $60 million up to $150 million range with equity requirements of, whatever, a third of that, so $20 million up to $60 million. They tend to be at the moment in multifamily, so, call it market rate multifamily, and they also tend to be in or student housing. So those two food groups have gotten hurt, but not as much as others. People are a little bit reticent to, at the moment, unfortunately, deal with hotels because they don't know what the travel is going to be like. And they're not dealing with retail because the retail is challenged at the moment. But the other deals are moving along, and we've gotten a bunch of renewable deals, on solar and on wind that people are thinking about and moving down the event horizon. So I think that it paused. It took in what was going on in the marketplace, and I think the hard part will be getting some of these deals closed because the numbers will have changed. Not that the deals are worth differently, but I think that lenders, the debt financiers on construction loans are going to take a more conservative view of what land is worth post-COVID until a couple of deals get done. And so I think that, again, things are happening, at least in our world. My sense is if it's happening in my world, it's happening in other worlds. We closed a deal 3 weeks ago. I've lost track every day. It feels like it's Monday again. But so about 2.5 weeks ago, we were lucky enough to be working with some fine folks down in D.C., and they're doing 191 units of market rate housing across from a metro stop. And so it's got transit-oriented development aspects to it. It's got 3 schools right nearby. It's got affordable housing components kind of right adjacent to it, and it's a market rate deal with some limited retail, like a ground floor restaurant. And so that deal was a little bit of a chore to get done, but it got done. So it was a $53 million loan from an affiliate of JLL's, and it was backstopped by HUD. And, they're building, now. So they closed 3 weeks ago, and they're in the ground now. And so, that's kind of the Ravinia group out of Chicago and City Interests out of D.C. And so they're in the ground now, and they're looking at their next phase already, because they feel like it's the right time. It's going to take them 1.5 years to build it. And by that time, knock wood, everything will have settled, and people will want housing. And so that paradigm is shared by many of the deals that we're working on, and they're kind of all over the place. So we've got deals I'm from New Jersey, and I work in New Jersey and in Philadelphia in our Philadelphia office. So there's a cluster of deals in and around Philadelphia and southern New Jersey and northern New Jersey, those deals happening. But we also have deals in Alabama, in 3 different cities in Alabama for market rate housing. We got a deal for assisted living. Again, a bit of a tricky food group at the moment, given kind of how COVID has moved. But that's moving along. We got 2 deals in LA. We've got another deal in Florida. We closed a deal at the beginning of the year before COVID kind of happened, or we knew it was happening, in Ohio for a couple $1 million. That was a social impact deal where a developer teamed up with an investor and is going to build 100 beds for formerly incarcerated nonviolent offenders. And so when they come out, where do? They go to this place. There's a nonprofit that, helps transition them back into, the community. And they teach them job skills and how to dress for success and interview skills. And so that nonprofit will lease the real estate and will run the program. And it's a lovely, it's an OZ deal. So it was an investor that was wanting to do good social impact, but they're going to make, probably like 23% on an IRR on that deal because the numbers are good. And so they're not only social do-gooders, but they're making money there. So, again, I keep, waxing on. These deals are all over the place. And, as you guys know, as Vicki said, there's 8,200 of these zones. And so, every state within, unless you're in a real rural area, every state within 15, 20 minutes, you're going to be able to find a zone. Does somebody like the real estate or the business they can create there? That was the other thing, kind of April, 2019. April, those rules come out, and they're very beneficial to businesses that want to start in the zone or move into a zone. And so there's been a lot of interest in the last 6 months before COVID on opening businesses in zones. And so I've got 4 of those deals going on. One's a software company. One's a daycare. One's a solar business. One's I forgot what the last one is. A property management company. So, and one's like a digital software guy and gal. And so they're all different kinds of people, all different kinds of deals, which to me keeps it interesting.
Yeah, when you talk about these deals, are you talking about just a basic real estate transaction where you help to close the deal in a real estate perspective, or are you talking about the actual creation of the fund?
No, the real estate's the fun part, sure. So it's any number of these pieces, Ron, but mostly it can be buying a land. It can be getting approvals. It can be negotiating a guaranteed maximum price contract with a contractor, negotiating the architect's agreement with the architect. It can be meeting with the community. It can also be, so it's all of that, which I'd put into a development deal, getting incentives, that kind of stuff. It can be financing the project.
That's very interesting because that kind of transcends the usual legal participation of just doing the paperwork.
Well, that's the fun of it. Anybody can do the paperwork, so the fun is kind of using the pieces too.
That's the boring part.
Yeah, well, it's not boring, but we all have our crosses.
It's more fun to expand it to other areas too.
Sure.
Be part of the whole picture.
Exactly, and so that's what I was taught at Brandywine by the fine folks there. Was I was involved in these deals from start to finish for the most part, and so that's the enjoyment for me is helping to structure it and helping to do it and then helping to close it. Now, it doesn't have to be all that, but it can be. And so to your point, Ron, most of the time I'm getting called because people hear that I've done opportunity zone deals and they want to understand the opportunity zone piece. And what happens is it morphs from there to any of these other pieces. But it's structuring the fund to take money in that's capital gains or non, but mostly capital gains. And then it's structuring the lower tier, typically a qualified opportunity zone business, which can be just a regular business, pizza parlor or a nail salon, or it can be a business that happens to be building and owning real estate. So, creating the structure that enables the appropriate utilization of the program tends to be the on-ramp to these deals. But as time goes on, I get asked to do many other things once people realize that, I've got experience doing it. They may have somebody already doing it, and that's fine. We're happy to play in the sandbox with people. Most of the time, I don't run with scissors most of the time.
So exactly, what I really like about this is that, we go to a lot of conferences and opportunity zone expos and things like that, and everybody that talks at these events and the panelists and everything, it just seems like a lot of times they come at it from a theoretical perspective and not like real world cases that's actually working or not. And what I'm taking from this podcast right now, and it's a really good thing, is that this thing is actually working, and there are deals that are going on, that have been going on, and continue to go on, despite all this doom and gloom about coronavirus killing everything and stopping all these deals from moving forward. So this is I mean, if anyone listens to this podcast and doubts that, here we are talking to somebody who's actually doing deals today, and in the real world. It's great. I'm really psyched that you came up with this report for us, because I'll tell you, I was starting to believe a little bit of this whole, doomsday scenario until the last couple of weeks. But
well, look, I don't want to be Pollyanna. People have died. I mean, a lot of people. And we've got some serious stuff going on to be solved on the healthcare side and on the how do you open appropriately and or not create a whole second wave or diminish the second wave. So that's a real thing that will have real ramifications, and a lot of people have lost jobs and they're not going to come back. So that's going to be a big thing and will affect real estate, of course. But to your point, before COVID happened, Nova Gradic, which does some great reporting and work in a variety of tax exotica things, so new markets, historics, low-income housing tax credits, they're all over OZs, so they're accounting folks, and they do a lot of seminars as well. They published a report a couple weeks ago that showed just the upward trajectory of the amount of capital that's flowing into opportunity zones, and it's not shocking, but it's staggering. So there's, from zero, there's $10 billion that have been invested into opportunity zone real estate funds. That could be the three of us doing a deal, or it could be 100 people doing a deal. Doesn't really matter. That went from 0 to 10 billion in like 2 years. And that 10 billion will build like $60 billion worth of real estate. So
exactly.
And we're at the beginning of this, not anywhere else. And so, sure, there are things that need to be modified in the program so that the program doesn't get taken advantage of. And reporting is one of them. So you hear the D's shouting a bunch about reporting. And the original two senators that created the program, Cory Booker from my state, New Jersey, and Tim Scott from South Carolina, they would both agree that they wanted reporting, and they still want reporting. And so I think that some level of reporting is definitely going to happen, and it should happen, so that when we're looking backwards 3, 5, 7, 10 years from now, we can say, yes, it worked here, here, and here. It didn't work there, and let's figure out why. And so I think to your point, I think it is working. It is getting capital into places that heretofore hadn't seen capital investment. It's getting product built or started to get built pre-COVID, which is good. The downside is, it tends to be people with capital gains that are utilizing the program because it's set up for capital gains. Well, who has capital gains? Tends to be people that have sold stuff that are relatively well off if they have the money to invest. So that depends on your perspective, good or bad. It doesn't have to be a rich person, but it can be, and be a rich person. And to the point of...
And that's not a bad thing, though, Brad, because the people 100%. With the money are the ones who are going to invest.
Yes. I'm just saying that, if you want to take a shot at the program, a rich person's scheme getting richer. That's kind of the negative. And that's not all accurate. I think there's a piece of it that's accurate, but it's not totally accurate. And, when you say where we started the conversation, which is, hey, we really need to include the folks in the neighborhood that's being affected in the conversation.
Right.
That's the piece that tends to get missed, which is, if a developer comes in and wants to build a 16-story, luxury townhouse development, and the neighbors want a 1-story, well, then there's a disconnect there. And so the ability to intermediate and have discussion around that and come to a rational conclusion that both sides are happy with, that's what's also missing. And so, again, the program can't mandate that, but that's local government doing what it should be doing to bring the parties together to find out what people are willing to do and what people are interested in so that they're not gentrified and, too quickly, and that housing prices don't rise too quickly like you saw in Seattle where, it's a little bit of the Facebook thing. It wasn't Facebook's fault, but, as they started to pay their people well, secretaries and assistants and mailroom people, all of a sudden they started buying houses, and the housing stock got overpriced for the local, population. And, you have to drive like an hour and 20 minutes to get, a decent priced house in Seattle, San Francisco, and other places. And so how you turn the dials on making sure that the local community isn't displaced and how you do it in a way that's appropriate, that allows them to stay and intersect with and be a part of the community you're going to build, that's a little bit of threading a needle. But it's important so that, people don't get tossed out of places they've been living in for 20, 30, 40, 50 years in the context of, hey, we're a builder and we're going to build. So there's a balance there.
Right, because I think people forget the prime objective of the program was to elevate the lifestyle of the people who lived in the opportunity zones and give them an opportunity to make their life better. And it's not about, I mean, it is about the tax deferment, but that should not be the primary focus on investing. It should be elevating the people who live there, and you can't do that unless you have a relationship with those people and with the local government to make sure that you're building what's necessary and what those folks need and what those folks want, because they're the ones who are going to spend the money there because they're the ones who are living there.
That's right. And it's neat, and the second part, it's the want part, where it's not jammed down their throat. It's a collaboration to get to the right, this is what the community wants, and this is what the builders are owners are willing to do. And the nice part about the program is its flexibility, in the sense that it's not just rich people that can participate. It's anybody, and it's not just, the sale of real estate that can be utilized in the program. It's anything, if you close your eyes, anything in your house or your apartment that you own that you sell if there's a gain, and so it's furniture, fixtures, jewelry, Bitcoin, art, booze, cars, whatever. Anything that you sell, including stock, if you own stock in Google and you sell and there's a gain, you can use that in the program. And so that to me is a really fascinating and good feature. The other part is that it can be used for building real estate and rehabbing real estate. So taking kind of obsolete real estate and rehabbing it, that's good. Building new stuff can be good, but it's also for businesses. And it can be small businesses. It doesn't have to be a massive thing. It can be a small business. And so both of those avenues work. That's what's, kind of really exciting in the program.
Yeah, and Brad,
it's all about jobs.
Yeah, right. One more thing before we close this podcast out. Talk about real estate, and there's a lot of 1031 investors out there who may be facing a busted 1031. A lot of those people can turn to opportunity zones as well. We've covered this on another podcast. Do you see a lot of people doing that, or you have inquiries on that as well?
I've had inquiries. It's not a lot. I've had a couple of inquiries. We almost got a deal done with an investor that had a blown 1031 at the end of the year. The rules in OZ provide some flexibility on that side of the ledger. And so there was a couple of inquiries, but the two people I was talking to out of, it's not every single day, but almost every day, I'm doing 1, 2, 3 OZ calls where somebody says you should talk to him or, whatever. And so there was a flurry of that at the end of last year. I have not gotten a 1031, busted 1031 call of recent ilk in the last 2, 3, 4 months. That doesn't mean they're not happening, but I have not gotten that call. And so it's the classic, it tends to be, because of my background, developer owner that is looking to build something, and so they're either going to do it with their own money or they're going to raise some third-party money. So that's where my securities folks are involved, where we will raise money in a private placement memorandum format with sophisticated investors and look to utilize those dollars as OZ dollars, hold that money for 10 years, get a return on that money, over the time period, and then look to sell the project after 10 years before 2047, and that investor or investor group ends up in a very good situation, in particular given some of the recent changes even after the beginning of this year, where as part of CARES, the ability to do net operating loss carryback is now, you used to be able to do that, then they changed the rules and you can't do that. Now you can do that again. So what's going to happen is some formerly profitable projects, because of these carrybacks, will become less profitable. They'll amend their returns and they'll potentially have the ability to utilize that in an OZ deal. A little bit longer than today, but that piece will be helpful. The ability to not have depreciation recapture is a huge advantage relative to these deals versus a typical deal. In a typical deal, you sell, you pay capital gains, and you have depreciation recapture. These deals you don't, because of the way it's put together. So that will be a big thing.
Right. So if an investor or anybody is listening to this podcast or they're reading the show notes and they want to get more information or have some questions for you, what's the best way to get in touch with you? Website, email? What do you think?
My friends would say email is the best way because I see it. Phone call tends to go into the voicemail void, so I wouldn't do that. If you text me on my cell, that's fine too. So I'll see that quickly. So either an email to my work email, Personal email just goes into the great beyond, because I don't even look at that. But work email and or cell phone text, either one I'll see, and happy to chat.
Okay, we'll put that in the show notes as well. And with all the webinars and the phone calls and all these things that you're on all the time, I really appreciate you taking the time out to talk to us and our audience, and it's been really informative and great. Thank you so much for that. And Vicki, do you have any closing remarks or questions for Brad?
Well, Brad, I think that you've elevated real estate law into something exciting, which is something people should pay attention to.
Well, I appreciate that comment. It's not too exciting. It's not too often that people call real estate law exciting. So I'll take that.
True fact.
Given. Yeah. I'm with you on that. I agree.
Yeah, it is. You've taken it into a whole new exciting world, and the passion in how much you love what you do comes out, and it's reflected in what you say, and that's special.
Well, I appreciate that. Typically, it's my dog at home that listens to me. Nobody else does, and so the fact that you're interested is good stuff.
Yeah, and everybody out there should be interested too. You definitely should contact Brad, because he obviously is giving out a whole world of information here. We're happy to have him on the podcast. Folks, you're out there listening to the MappableUSA.com podcast, that Mappable USA, and we are looking forward to bringing you the next show. We've got on our website, you can scroll down there. You see all our syndication sources. Just pick the one that you like best so you'll never miss another episode. If you like today's show, send us an email, info@MappableUSA.com. Let us know, or place a comment on the page that you're listening to this podcast at. And lastly, if you want to be a guest on the show, like Brad was today, there's a guest tab on there. Just fill it out. We'll see what we can do about getting you on the show. So once again, everyone, thank you for all your support. Thanks for listening, and we'll be at you next week with another Mappable USA podcast. Have a great week, everyone.